Crypto didn't just get legitimized, it got institutionalized. And that shift is happening through one instrument most people overlook. In this video, we break down exactly what's happening beneath the surface. First, we explain what crypto ETFs actually are, why institutions are using them, and how institutional adoption is changing the structure of the crypto market. Next, we'll address the big question everyone's asking. If institutions are buying, why is crypto still down? We'll break down the October 10th crash, what caused it, how it temporarily paused institutional allocations, and why its timing within the 4-year cycle intensified the sell-off. After that, we shift focus from price action to capital flows, why following the money matters more than following candles. You'll see how institutional allocations have quietly surged since January 2023. And finally, we'll tie it all together with the most important question. What does all of this mean for you right now? Let's get into it. ETFs, or exchange-traded funds, allow institutions to gain exposure to assets like Bitcoin without directly holding crypto. Since the approval of crypto ETFs, large asset managers, pension funds, and hedge funds have steadily increased their allocations. This matters because institutions don't trade like retail. They don't chase short-term price moves. They allocate capital with multi-year horizons, often rebalancing, not selling on volatility. As institutional ownership rises, liquid supply tightens. Price discovery shifts from speculation to allocation. And volatility becomes less emotional and more mechanical. For individual investors, that matters. Because a market dominated by long-term capital behaves very differently than one driven purely by leverage and hype. But if institutions are adopting, why is crypto still down? That's because institutional adoption hit a wall, and one event changed everything. On October 10th, 2025, the crypto market experienced one of the largest single-day liquidation cascades on record. A surprise US tariff on China triggered rapid deleveraging, wiping out over $19 billion in positions within 24 hours. Bitcoin fell sharply from recent highs and confidence across markets weakened. The impact went beyond price. ETF inflows briefly turned into outflows, signaling that institutional investors paused allocation as uncertainty reset. At the same time, market psychology shifted. With the crash occurring late in the traditional 4-year cycle, many participants began to believe the cycle had already peaked. That belief intensified selling as the market searched for a bottom rather than a new peak. So even with institutional demand, macro shocks and cycle expectations kept price under pressure. But follow the capital, not the candles. Here's where the long-term picture matters. Since January 2023, Bitcoin held by public and private company treasuries exploded from 197,000 BTC to over 1.08 million BTC. That's a 448% increase in less than 3 years. That isn't leverage. That isn't meme money. That's balance sheet capital. Corporate treasuries and ETFs are becoming a structural buyer base that soaks up circulating supply, anchors demand to long-term strategy, not hype, and adds a new demand floor every cycle. Every quarter more Bitcoin migrates into corporate vaults. Crypto looks less like a speculative toy and more like a reserve asset. For individual crypto holders, this is the key takeaway. Crypto is no longer just a trade, it's an allocation class. That doesn't mean straight-line gains. It doesn't mean cycles disappear. But it does mean corrections happen inside stronger structural demand. Volatility reflects positioning, not pure panic. Patience is increasingly rewarded over reaction. The October 10th crash didn't invalidate institutional adoption. It tested it. And the capital never left. It waited. So the question isn't whether institutions are here. They are. The real question is whether the October 2025 sell-off marked the end of a cycle or a reset inside a market that's structurally stronger than ever. And for the first time in crypto's history, the answer depends less on retail emotion and more on how institutions allocate next. If this breakdown added clarity or changed how you're thinking about the market, consider subscribing for more weekly analysis. And if you found it valuable, a quick like or share goes a long way in supporting the channel. And I'm curious, did this shift how you're viewing crypto or how you're positioning going forward? Let me know in the comments. I always read them. I'll see you in the next one.